Well, welcome everybody back to an episode of Compound Thesis. I'm Jim Hiltner. I'm the head of sales at Compound. Our guest today is Fabian Astic, and he's a managing director, the global head of DeFi and digital assets at Moody's Investor Services. Welcome to the show.
Thanks, Jim. Happy to be here.
Yeah, it's great to see you. So, would love to kick off a little bit of background. How did you get interested in DeFi, and just share about what's driving Moody's to look more closely into this space?
Sure. So just before creating my new department last summer, I was responsible for quantitative analytics and innovation at Moody's Investor Service, MIS in short. I use the acronym a lot. And with that innovation hat, my team and I monitored the blockchain and digital asset space for several years in passive monitoring mode, as I like to say. But towards the end of 2021, we noticed that things really started to accelerate with some technical hurdles being solved and a lot of policy and regulatory work being done to solve the regulatory gap in the digital finance space. And that's when we decided to go from passive monitoring to active engagement as the digitalization of financial markets was accelerating faster than before. So now is the time to get ready before financial markets are fully digital. And today, digital finance is pretty much everywhere across the industry. The digitalization is illustrated by a pretty wide spectrum of activities and developments, from investment in blockchain and distributed ledger technology, or DLT in short, another acronym, to the tokenization of everything: bonds, stocks, real estate, art, you name it, to the creation of new assets like stablecoins and CBDCs and NFTs, and all the services to manage them, like custodians and exchanges, and sometimes with a centralized design with more traditional intermediaries exchanges and banks, and sometimes with decentralized designs with no intermediaries but only computers talking to each other, with code automatically running when some pre-agreed conditions are met. And there is a mix of old things and new things in that world. And really what we're doing at MIS with the subject matter expertise of my department is to get ready and help market participants get ready to ensure that we are all well prepared as the market evolves. And that means first helping market participants understand all the new risks out there and how they interact with more traditional risks. And it also means getting ready as a business to interact with our stakeholders digitally on DLT platforms when they want us to, which requires, among other things, a lot of process work, data and technology work, and of course, controls and risk management.
So no need to apologize on all the acronyms. Where crypto and finance, is famous for all the acronyms. So easy to follow along. And I think a lot of the market structure, as you're seeing it evolve in crypto, is obviously mimicking a lot of the traditional financial infrastructure that's been built. As you mentioned, exchanges, custodians, broker dealers, you name it. None of that is necessarily new, but it's certainly built on new rails. And I'm curious, just if you don't mind, like you mentioned a lot of different stakeholders there. Could you tell us about some of the different types of folks that you work with? Is it banks, asset managers, insurance companies? I'm sure you span a pretty wide gamut, but just curious the types of clients that MIS is working with.
So really all of the above. And actually it's interesting because since we're talking to the entire market, we've even built the team in a way to really respond to everything that's happening. So essentially our thinking was, we can't do things in a siloed way, talking to pockets of the market. We can create a group that goes into the future alone, leaving all the other business units behind. And at the end of the day, whether you're looking, for instance, at the credit risk of a traditional bond or that of a blockchain-based bond, a bond is a bond, a rating is a rating, and it will be assigned by our rating teams. And same thing for technology work, and same thing for research, and same thing for relationship management. So a lot of the people that we talk to are the same as people we have always talked to. There are new market participants, those that are specific to the digital finance world. And really what we needed was the expertise and the processes of all the departments in the organization. We really needed to get ready together two key ingredients. subject matter expertise, and the participation of all the departments across the rating agency. And we did just that. So we first created my group, DeFi and Digital Assets, bringing together subject matter experts and supporting knowledge building and driving strategy around digital finance, as well as coordination across Moody's, as well as outreach, to talk to everybody out there. In addition to the core team or center of excellence, I should say, my leadership team has senior leaders from all the departments of the rating agency, which is a way to ensure shared accountability and smooth collaboration, and also to ensure that we're talking to all the right parties out there. And we also created a network of champions within various departments, including our rating and research teams. And the champions are typically nominated first to design, lead, or support the implementation of digital finance initiatives within their area of coverage. And they also serve as on-the-ground references for other employees.
Yeah, fantastic. So, I mean, you mentioned as your team is focused on the digital finance and the digitalization of financial markets. In your own words, what does that really mean? Can you break that down for us?
Yes, I can. And I know it will sound like a broken record to people who have heard me in other forums, but I think definitions are really important. So digital finance is the generic term that covers all aspects of finance that include DLT and digital assets. And I like to break it down into three buckets. The first bucket is digital infrastructure, or as I like to call it, modern back-end financial plumbing. And it's all the usual assets and transactions that we have in traditional finance, really, but made more efficient and potentially cheaper by blockchain-like technologies. And in this bucket, you have things like digital bonds and asset tokens and security lending transactions and many others. The second bucket is native digital assets. And it's really all the new assets and structures that can only exist thanks to technologies like blockchain. And in that bucket, you have unbacked cryptocurrencies and native tokens and stablecoins and central bank digital currencies and DeFi protocols. And then the third bucket is digital exposure. So it's really all the existing kind of more traditional structures, but exposed to new risks and all the assets in bucket two, really. And it's, for example, banks and asset managers and exchanges, but also non-financial organizations that are more and more exposed to digital assets and digital risks. And I like to use this classification because it makes it very easy when you talk to internal or external audiences to explain that cryptocurrencies and crypto finance are just one component of digital finance. In particular, no cryptocurrencies are involved in the first bucket, and crypto finance is really just a subset of digital finance, which involves cryptocurrencies. And decentralized finance, or DeFi, is an even smaller subset where only computers talk to each other, and the usual companies and intermediaries are out of the equation.
So in that first bucket, as you look at the efficiencies that blockchain technology will bring to capital markets, can you highlight a few examples of exciting opportunities that you're seeing that might transform the financial markets across choose your favorite asset class?
Sure. Well, first, it's really what you just said. It's really all about efficiency. And today's financial infrastructure is often slow and it's expensive and it's supported by legacy systems. And you have a lot of manual steps and many parties are involved along the way in everything that we do in finance. So it's slow, it costs a lot of money. And blockchain technology, or actually DLT more broadly, reduces the number of intermediaries, the number of manual steps, downtime, and it actually goes beyond finance. For instance, some manufacturing firms are considering blockchain to improve the traceability of goods and commodities across the whole supply chain. The adoption of DLT didn't pick up as fast as many expected a few years ago because of a few hurdles that were not foreseen. But we still believe that the technology can help, for instance, banks modernize their legacy systems by reducing settlement time and automating manual processes, reducing error handling, and enhancing reporting. So it often works with smart contracts, which I actually referred to earlier without naming them when I talked about code automatically running when some pre-agreed conditions are met. And with those smart contracts, you can, for instance, automate payments and cash flows. Things like if price XYZ reaches $100, make a payment of $90 from Bob to John, or if all the values of a given report are in compliance with pre-agreed amounts, transfer digital token ABC to Jane.
Mm-hmm.
And with features like that, settlement times, which I mentioned earlier, can be reduced from several days to just a few minutes or even a few seconds, which can in turn improve customer service and reduce the cost of counterparty risk management and also ultimately a bunch of other costs. So banks and other financial institutions and other institutions really can use all of that. They can set up immutable and transparent data records, which facilitates reporting and compliance efforts. Well, now, before I give you another few examples of things that we're seeing, we have to be realistic. All of this necessitates significant investments. It may cannibalize existing profitable divisions. And there's also issues with interoperability, which means that you may not be able to have all the stakeholders that you need in your DLT environment, and your DLT environment may not be compatible with the DLT environment of others. So it will take some time before DLT's positive effects are significant and measurable. But the work is continuing. And even though banks have been very cautious with respect to cryptocurrencies, and we expect them to continue to be cautious until there are clear regulatory frameworks helping them prudently and safely engage in the sector. But apart from that crypto space, banks have been experimenting with many aspects of DLT and the various ways to make things more efficient that I mentioned before. And another example, which we have seen several times over the past few years, is blockchain-based bonds. Mm. We actually just rated another one a week or two ago, and a couple of others a few weeks before that, towards the end of last year. There's also trade finance, which is a very promising area for DLT because of the high volume of paperwork and multiple parties involved along the way. And maybe finally, asset managers have entered the ecosystem as well. Some of them offer crypto investment services, but we don't expect them to be a major revenue driver yet. And some asset managers have started to use blockchain technology to tokenize private investments. And it's also a pretty nascent development, but it's definitely worth keeping an eye on the sector.
Lots to stay on top of and touching many different areas. But I think one of the things that's interesting about, blockchain technology or DLT is the ability for, just radical transparency in financial markets. And often a lot of the, transactions are hidden behind walls, which, certainly, obfuscates certain activities on purpose. And the privacy is necessary in certain instances. But, how do you think like institutions are balancing that trade-off between, radical transparency and the privacy needed, as they manage, certain risks on their balance sheet or certain transactions? And just curious your thoughts on that trade-off.
Sure. So there's probably a number of ways to answer the question. Well, first, a lot of the work that we see done by financial institutions is on private blockchains or hybrid blockchains. So not everything is public, but certainly when it comes to public blockchains, cyber risk is key. And just as an example, in 2023, I think roughly $3 billion were lost in the sector because of cyber attacks. So think about it, like the entire ecosystem is relying on a series of technical layers. You have user interface, you have smart contracts that I mentioned before, you have hardware, and each part is susceptible to vulnerabilities. So blockchain technology, again, when you think about it, it's a bunch of computer code and it's all web-based. So almost by definition, it's subject to cybersecurity. And public blockchains even more so, because by design, they're public. That you can see the code of the projects, which creates more opportunities for hackers to read the code and find ways to get in, and they can exploit flaws in the code or even in the business logic itself. So on the positive note, hacks against centralized finance businesses like crypto exchanges have declined. But the other way around, cyber attacks against DeFi applications, financial platforms that essentially enable participants to interact without intermediaries, just computers talking to each other. Those DeFi attacks have increased since 2021. And overall, the ecosystem is not really standardized yet, which makes it hard to put in place systematic cybersecurity rules. But things can be done to significantly mitigate cybersecurity, cyber risk, and some security firms offer, for instance, third-party audits, which can help patch some vulnerabilities at the time of the audit. But efficacy seems to vary from an audit to another. Other ways to reduce cyber risk include adhering strictly to coding best practices and partnering with incident response teams. It's not really clear that small projects, in particular in the pure DeFi, like startup world, systematically follow all those steps, but large projects, in particular those sponsored by large global financial institutions, are likely more rigorous with those practices, in particular because they have more money to spend on things like cybersecurity and code quality.
Yeah, absolutely. And I think the longer that these systems continue to develop, and because it is public and these exploits and or hacks are seen in real time, there's a lot of learnings that come out of those painful episodes, and certainly anticipate further hardening of these systems based off of recent activities. I think the other thing too is that being able to understand, like, there are a number of service providers that look at these protocols from a risk management perspective, and are also underwriting or analyzing the ability to manipulate a particular market, like we saw with like the Mango hack back last year. There's a lot of information and insight and learnings from that episode that I think a lot of other protocols will take into consideration as they continue to build their markets and think about what type of levers, not just from like a code perspective, but also from a risk management perspective, can we implement to reduce or eliminate those types of opportunities for exploiters in the future. So continue to evolve, and despite all that's happened in the last couple of years, there's still a tremendous amount to go, and it's still a very nascent industry. Yeah. One thing that you touched on earlier that I thought was interesting is just the efficiency that this produces reduces not only barriers to access, but also the costs of certain financial products. And so a lot of advocates talk about financial inclusion as one of the benefits to this innovation. Is this really the case? Can you elaborate, any specific examples that you can point to where this is helping reduce friction for, consumers or businesses or individuals to participate in the financial ecosystem that previously were not available to them?
Sure. So I don't think it's that obvious for all areas of digital finance, but it's likely true for some applications like payment systems and cross-border payments in particular. Because, for example, transferring money globally is slow and expensive, and making those transfers cheaper and more efficient matters to a lot of people. According to the UN, roughly 1% out of 9, I believe, relies on money sent back home by migrant workers, and approximately 7% of that money goes into fees. And it can take up to several days for a single dollar to go from the US to another part of the world. And it's not just for global payments. Last year, the White House released a fact sheet stating that roughly 7 million Americans have no bank account, and that another 24 million have to rely on costly non-bank services like money orders. And blockchain in the digital finance can help with financial inclusion thanks to faster and more convenient and lower cost transactions, like I mentioned before. So that's all the efficiencies that we covered previously. And essentially, pretty much as soon as you have a cell phone, you have access to financial services that you may not have access to otherwise. Some digital assets like stable coins and or central bank digital currencies could really help with that. Stable coins, which are still a very small market today, it's under $150 billion. They're mainly used to trade cryptocurrencies without having to convert your trades into fiat money back and forth. So it saves time and money, and they're also used as collateral in crypto lending programs. But stablecoins have the potential to become an efficient global payment system. And that's why there's a lot of policy work being done on the topic today.
Well, I would be remiss not to take the last, nugget that you were just dropping there and try to get your insight a little bit on regulation and policymakers. Obviously there's a lot of discussion given all that's happened and some progress being made, especially it seems like the stablecoin bill is kind of like top of mind, at least in the US, but I know you have a global remit. So we'd just kind of love to get a sense of the regulatory landscape and what you're seeing, what we should expect coming in this year or in the not too distant future.
Sure. There's a lot to say.
Yeah.
I'll try to be brief.
We could do a whole separate episode on that.
But I'll start with the EU because there's quite a comprehensive framework in the EU that's about to kick in. First, in March of this year, so just a few weeks from now, their DLT pilot regime will go into effect, and it's essentially a regulatory DLT sandbox, which will allow all sorts of activities related to tokenized financial instruments, including issuance and storage and trading and settlement. And the other big piece of legislation in the EU is MiCA, the Markets in Crypto Assets Regulatory Framework, which the European Parliament is expected to vote on within the next few months, possibly in April. And it will be effective in 2024, but you'll start to see the effects before as everybody is getting ready for the effective date in 2024. And among other things, MiCA sets redemption and reserve rules for stablecoins, and it also limits the volume of non-EU currency denominated stablecoins, which is an interesting bet, which can either accelerate innovation and push for the creation of new euro stablecoins there. But if it fails, given that the vast majority of stablecoins today are in USD, it could also limit the fuel in the EU crypto ecosystem. And the rest of MiCA covers capital requirements and other governance rules for crypto asset service providers. On the other side of the channel, there's quite a lot happening as well in the UK. In July of last year, the first crypto regulation was introduced with the Financial Services and Markets Bill. It's not final yet, but in its current state, it's different from MiCA in the EU as it only provides general guidance for stablecoins as opposed to specific rules. And there will be a consultation period once the bill's passed. And after that, the Treasury and the Bank of England and others will set the actual rules. And the bill will also address a DLT regulatory sandbox. There's also quite a lot happening in Asia, including Hong Kong and Singapore and South Korea and Japan, with various initiatives to regulate digital assets and crypto finance. And last but not least, here in the US, there's been a lot of activity as well, but no real conclusion yet, as illustrated by the very high number of bills introduced in the last Congress, often bipartisan, but that didn't conclude and essentially everything reset with the new Congress. On the one hand, there is a sense of urgency following a number of events that you're really familiar with, which took place in the crypto world last year and this year, including, of course, the collapse of FTX. And policymakers and regulators focus on protecting consumers and financial stability. There was a real sense of bipartisanship on these questions last year, and my guess is that there will be some bipartisan agreements this year too. Now, will there be a comprehensive framework for crypto finance and the broader digital finance field in 2023? Probably not, at least until all the events of last year are fully investigated and mainly settled. But in the meantime, we expect more targeted efforts like stablecoins again. And it seems that Congressman Patrick McHenry and Congresswoman Maxine Waters are close to reaching a bipartisan agreement. For the time being, with no crypto legislation out there, US regulatory bodies will continue to increase pressure on the crypto industry, and both the SEC and the CFTC have been pretty active. And maybe one final note on pure DeFi. it is notably not in scope anywhere.
Mhm.
There are already calls to include the sector in future regulation or future legislation, but it's not in the frameworks that I mentioned earlier. And we are very likely many years away from a regulatory framework for DeFi, which, by the way, may look very different from regulatory frameworks in the rest of crypto finance. And for example, rules like reserve requirements and leverage and I don't know, other governance considerations may be embedded in the code of DeFi protocols. But in the meantime, what we've seen with recent actions by the CFTC and the SEC is that regulators are nonetheless keeping an eye on the sector. And if some bad actors try to exploit design flaws or weaknesses in DeFi protocols to steal money, they will likely be prosecuted.
Yeah, absolutely. Profitable trading strategies don't go unpunished, apparently. So lots to come, and I think the industry, as you know, you probably seen all of your conversations, and we certainly do on our end as well. Certainly welcome the clarity and the collaboration with regulators. It will take some time to get through, but it's good to see on a global front that there is progress being made, despite all of the kind of headwinds that potentially could stall some of the progress given all that's happened over the last call it 6 months since I joined crypto. Coincidentally joined right before Terra Luna collapsed, and have seen quite a bit of change over the last 8 months since being in the industry. But it's been great to have this conversation with you today. Very excited for folks like yourself that are continuing to do the great work you're doing. Really appreciate it. We'll definitely have to have you on again at some point and kind of see where the world lands. We spin the globe behind you a couple more times and see what crypto looks like in a few turns. But appreciate everybody joining for today's episode. We'll be back again in a few weeks with another great guest. Talk soon. Thanks, Fabian.
Thank you.